Lending Club, my largest position, is down almost 30% after posting their Q4 earnings report. In this video, why did it drop? Am I buying or selling? And my analysis on their most recent report. Let's do it. So yesterday I took a risk and I put my opinion out there in this video yesterday, which is never easy to do. And to be fair, we actually called a lot of it correctly. They did beat on their Q4 numbers, and their guidance did dictate where the stock price went, and their net interest margin was expanding for the reasons we expected. If you remember, there were three things I said I would be looking for in this report. The first was recessionary and macroeconomic comments, next was net interest margin, and third was guidance. The format of the video is what was bullish about the report, what was bearish about the report, and then finally an updated valuation. And I have a new kind of paradigm shift or new perspective on the valuation, which is really fascinating and probably explains why it dropped 30% today. And I can't wait to share it with you guys later at the end. Jumping right into the bullish points, their numbers for the fourth quarter were actually pretty good and they beat on their previous guidance handedly. They saw annual revenue for 2021 up 157% year over year to $818.6 million. With marketplace revenue up 136% higher and their new recurring stream of net interest income up 259% year over year. For context on why that 157% annual revenue growth was so insane, in Q4 2020, before the year of 2021 began, they guided for full year 55% year over year revenue growth, and they 3x'd that. They finished the year with $18.6 million in GAAP net income, not adjusted. And did you know that at the beginning of 2021, they also guided for $175 to $200 million in losses for this year. So not only did they turn that all the way around to become profitable, but they're continuing to be more profitable, as we'll take a look at soon. That said, with these great numbers, they did disappoint on their earnings guidance, which we'll get into in a second. Now on to net interest margin, which was a big point of the last video and a big part of understanding LC's profitability. The fact that revenue grew independent of the slowdown in originations means that they held more loans for investment on their balance sheet and their net interest margin increased. Net interest income grew 27% quarter over quarter to $83.1 million, and their loan portfolio grew by 22% quarter over quarter. Their net interest margin grew to 8.25%, up 119 basis points or 1.19% quarter over quarter. This is due to a higher mix of consumer loans. This growth in net interest margin also accounts for 8 basis point increase in funding costs during the fourth quarter. In other words, accounting for the fact that they're paying out 0.08% more to their depositors where they get their capital to loan out money, their net interest margin still grew by 1.19%. Lending Club also saw a growth in deposits. In Q4, they grew their deposit base by 11% to $3.1 billion, with an average interest-bearing deposit rates of 0.38%. This growth in deposits is crucial because this capital allows Lending Club to keep growing their balance sheet and thus their loan portfolio. And this next part right here was probably one of the main highlights of the conference call in my opinion. In 2022, we expect interest rates for these savings accounts will increase. This means that Lending Club will have to pay more interest to people who deposit with them. Their cost of capital will rise. However, just as we saw in the fourth quarter, the higher mix of consumer loans will more than offset the higher funding costs, allowing our net interest margin to further increase. So not only is our net interest margin going to maintain and stay steady, but it's actually going to grow. And again, last video, we talked about a concept called maturity mismatch. This talks about how the length of loans is key in maintaining NIM in a rising rate environment. Well, they remind us that their loan portfolio has a very short duration of about 1.5 years on average. So as rates increase and the portfolio runs off, they can reprice the loans to reflect the new rate environment. So as far as what I heard on net interest margin this quarter, check mark for me. Next up was their guidance, which was both bullish and bearish. They guided for $1.1 to $1.2 billion in revenue and $130 to $150 million in net income. This means that they expect to grow by 34 to 47%, and with Lending Club's history of beat after beat, I'd expect them to end the year at least on the higher end of these estimates, meaning we'll probably see growth of 47% and a net income margin of 12.5%. Furthermore, if you look at their market cap after today of $1.59 billion and divide that by $150 million in earnings, that's a forward PE of 10.6. At first glance, that may seem cheap for something growing this fast and something that's considered a fintech. However, I'm going to show you guys another comps table that I just whipped together this afternoon that might show you otherwise, and it's actually kind of a bearish argument towards LC. After this video, there's no excuse to say that I haven't looked at the bearish side. So with that said, let's jump into the bearish side of the report. The The marketplace revenue was down 2% quarter over quarter. And when you're looking at a growth stock like this, you never want to see a drop in growth in any aspect of the business, no matter what it is. However, there seemed to be a very reasonable explanation for this. Number one is the seasonality of the fourth quarter. We saw this in the Google Trends from the last video, and it's typical for banks to see lower loan demand in Q4. Also, in Q2 and Q3, those are usually Lending Club's strongest quarters, whereas Q4 and Q1 are usually their weakest, seasonally speaking. The second point why this might be explained is in Q3, they held 20% of the loans that they originated on the balance sheet for investment. However, in Q4, the most recent quarter, they held 25% of the loans, which means they literally released a smaller percentage of loans to the marketplace to begin with. So remember, it's 3 times more profitable for them to hold onto loans themselves than to sell them on the marketplace. So yeah, marketplace revenue declined, but that's why overall revenue and earnings still rose. Another bearish point is that originations as a whole were actually down. Now is also probably a good time to mention that I did sell out of my small position in Upstart today and made a community post about it literally minutes afterwards in the sake of transparency. I wasn't going to get this video out until after market close, so I wanted to at least try and let you guys know while the market was open. My main reason for selling is all outlined here, and I will still keep it on my watch list. And finally, not quite a bearish point, but something I definitely should have mentioned in the last video regarding recessionary fears is that the average member at Lending Club generally has over $100,000 in annual income and a FICO score of over 700. So at the very least, their member base, although they have high debt, also has high credibility. Finally, the most bearish thing of all from this report was their guidance for 2022 in terms of earnings. Simply put, their guidance of $150 million in earnings translates to an EPS of roughly $1.50 per share. Analysts wanted $1.73 per share. So they beat on the numbers they posted in Q4, but they missed on guidance. And like I said in my previous video before earnings, guidance in the conference call would make or break the stock price the next day. So yeah, this is another big reason why the stock dropped. And another reason it dropped is because it did have a gap to fill at $16 if you're looking at it from a technical perspective. That has now been filled, and we'll see if it holds. All right, so that's a brief recap of the report, but this next part is really the crux of the bear or bull argument for a Lending Club. And this is going to determine whether or not it's at $40 a share or $10 a share. You see, it all comes down to how Mr. Market views Lending Club, as a bank or as a fintech. My bullish thesis from before was that it should be valued like a fintech, and that's why it looked so cheap when compared to other fintech stocks, even in the $30 range. However, the market doesn't give a crap what I think, so whatever the market wants to do, the market does. And right now, the market sees Lending Club as a bank, and it's made it very clear. So I looked again at my valuation, but this time I made a comps table comparing Lending Club to banks instead of fintechs. And this is where it gets even more interesting. TLDR, Lending Club looks either fairly valued or slightly undervalued in my opinion when compared to banks at this new price of $16 per share. So I gathered a range of banks from very large to very small market caps. And when investors look at banks, they tend to look at a ratio called the price to book ratio. And by the way, anyone in the investor community, you have access to this spreadsheet right here. So based on the price to book ratio, if we take the average of all these banks, Lending Club is slightly above the average. So I marked it as kind of yellow or orange. Then next, I looked at the price to earnings ratio for the next 12 months or next 12 months PE. And in this case, Lending Club is actually the cheapest of all of these banks. So that was really, really surprising to see. And then I looked at the next 12 months price to sales ratio. So if we can take a look at this, we see the average price to sales ratio for the next 12 months of these banks is 3.41. Lending Club's is 2.1. And next I looked at the revenue growth from 2021 and 2022 expected. And we saw that Lending Club handily beat all of the other banks, not only in 2021, but also in 2022. And 2021 might be a bit deceptive because they didn't have Radius Bank acquired in 2020 yet, so that's why it's such a massive jump. But in 2022, where they have like a full year basically of acquiring Radius Bank and having all those loans on their balance sheet, they're still expected to grow 41%, which is much higher than the average of 10%. And the next highest one is probably MCB, which is 26%. Next, we looked at the net income margins through 2021, and Lending Club was much, much lower at 3.66%. And obviously that's because for half the year, they were producing negative net income or negative earnings. Moving into next year, that's going to 4x into a 12% profit margin. And then moving into 2023, that's going to become an 18.8% profit margin. So they're still the lowest profitability wise amongst all of these banks, because a lot of them are much more mature than Lending Club, and that's what their focus is, profitability. But Lending Club nonetheless is growing that profitability at a rapid pace. So there is one downside there. Notably, Connect One Bancorp, if you guys are looking for other bank stocks, is growing pretty dang fast. So looking at this, again, that's why I think Lending Club is either fairly valued or slightly undervalued when comparing it to other banks. Now, if we look at other fintechs, so I wanted to revisit this just so I could show you guys why I assumed Lending Club was so dang cheap in the $30 range. And this is also why I believe that the stock market crushed Lending Club today, because now it brought it back in line and actually cheaper than a lot of bank stocks. But if we're to look at fintech stocks, which have also been crushed in the past few months here, we can see that Lending Club is still the cheapest one by far on a next 12 months EV to revenue basis at 1.4. It's also the cheapest one by far on a next 12 months PE basis, and two of these stocks are not even profitable. And it's also keeping up with the average, above average in terms of revenue growth with these fintech stocks, and it's not far off the most high growth stocks in this category. So that's why Lending Club looks so dirt cheap in the 30s, especially now compared to the fintechs, and that's why it actually looks in line or undervalued when compared to banks, and why I continue to buy Lending Club today. Again, Lending Club remains my largest position. I did buy another 100 shares. That said, never fall in love with a stock. After today's ad, I'm going to be staying patient and probably won't buy any more Lending Club for a little bit. I want to see how things shake out. Additionally, the reason why I'm waiting is because the boat is pretty much full for me with my position in Lending Club. It takes up about 10% of my portfolio, and it would be actually reckless and foolish of me to continue to add and potentially overexpose myself to one stock, at least from my portfolio management style. I'm a big believer in strategically buying the dip and not just aping into stocks when they're big red. If it does continue to fall from here, I've just shown you why it would actually be cheaper than even bank stocks, and I would continue to buy at that point, because one, it means that the stock has gotten cheaper, and two, it also means that my position has likely gotten a smaller allocation in my portfolio because the market value has dropped, and that puts me in a good position to add more. And the last thing I'll say is I do feel as though I did solid research, and research I'm proud of, on Lending Club. I learned an extremely valuable lesson in terms of paying attention to the macroeconomic environment, and also seeing how the market values a certain stock. It might be different from how you see it. And oftentimes that's what actually gives you an edge in an investment. But in this case, I assume that it should be valued at the higher one of the two between fintechs and banks. And that's where more downside was found once it was valued as a bank. So it's not like I just slapped on a PS ratio and called it a day and called it a buy. I actually put up research I was proud of. So with that said, everyone out there, good luck in the markets. It's a crazy one to start the year, and I'll see you in the next one. Subscribe.